Good afternoon. On behalf of Kothari Auditors and Accountants and Global Business Services DMCC, I, Akriti Mathur, extend a warm welcome to everyone present here for today's webinar on amendments to the UAE VAT law. Before we begin, I would like to give a brief overview of how the webinar will flow. This webinar is expected to take approximately 40 minutes and will be followed by a question and answer session of about 20 minutes towards its latter part. All participants will be on default mute mode except for the presenters. Having said that, we would love to hear from you, and if you wish to ask any questions, you may post in the chat box or click on the raise your hand option at the bottom of the screen, and your questions will be answered by our speakers in the Q&A session. Before we proceed further, a brief introduction of our company, Kothari Auditors and Accountants. Established in the year 1992, KAA has been proudly embarking on its journey in the professional field for more than 29 years, providing management and financial consulting services, including audit, accounting, VAT, and company registration services. Kothari Auditors and Accountants operates from two offices located at Khalid bin Walid Street in Dubai and Bank Street Rola in Sharjah. Our associate office, Global Business Services DMCC, which was established in the year 2010, is located at Jumeirah Lake Towers in Dubai and specializes in the formation of global entities, trusts, and foundation in the UAE and worldwide. We strive to provide exceptional, world-class services to our clients, and we hope this session will give guidance and clarity on the latest amendments to the UAE VAT law. It is my privilege to introduce before you our speakers for today. Mr. Vipul Kothari, founder and head of KAA and GBS, will brief the gathering on the overview of UAE tax laws and changing landscape of tax in the UAE. Mr. Kothari has the distinction of passing the Chartered Accountancy at the age of 21 from the Institute of Chartered Accountants of India, and has received gold medals from BK School of Business Management in MBA Finance. The session on recent amendments to the VAT laws in UAE will be presented by Ms. Kinjal Mehta, Manager, Tax and Compliance. Ms. Kinjal is a Chartered Accountant and Company Secretary by profession and has over 10 years experience in the field of direct and indirect taxation in India, Kuwait, and UAE. She also holds a diploma degree in international taxation from ICAI. Mr. Prasad Bonde, Senior Manager, Audit and Tax, will take up the Q&A session. Over to Mr. Kothari to take the session forward.
Thank you, Akriti, for the welcoming remarks and the introduction. Good afternoon and a warm welcome to all the participants today in this session on the UAE updates on the UAE VAT regulations. Before we actually go to the updates on UAE VAT law and regulations, I would like to briefly share about the UAE regulatory compliances which are applicable to the corporates here. So, as majority of you are aware that UAE had not been a highly regulated economy, and very few corporate compliances were in existence up until, let's say, 2017, barring licensing regulations and employee related regulations. And there were some sector specific regulations if you are practicing, let's say, medicine, or if you are into some certain profession which has some other oversight or some other bodies, there were some regulations which were required to be complied with. But general corporate regulations were very few. However, over time, what has happened is the global world order in terms of the economic regulation has undergone a tremendous change. And in last decade, there has been a big change specifically coming in from OECD, FATF, which is Financial Action Task Force, and the European Union. And due to their monitoring and review, it has resulted into UAE also implementing these best international practices in terms of regulations for corporates. So as you are all aware of, that UAE introduced VAT and excise tax in the year 2018. And this was the first set of regulations which actually came into being to ensure that UAE also is at the same international standard in terms of the corporate governance and regulations. And this was followed by many other regulations like economic substance regulations. Then economic substance regulation was followed by the ultimate beneficial owner regulations, which requires that if the beneficial owner is other than the one which is declared in the license, it needs to be then reported to the authorities and the information needs to be filed. Economic substance regulation requires that a company which carries out activity in UAE and specifically certain activities which are listed in the law as relevant activities like transactions with your group companies, banking, insurance, investments, and many other such activities. If you are carrying out such activities, you need to ensure that you have proper substance and you have adequate expenditure, you have adequate assets. This is to prove that it's not just a company set up to do the transfer of profit and shifting of profit in order for tax evasion or avoidance in other jurisdictions. These were also followed, I would say not followed, but followed by tightening of the anti-money laundering regulations. These were already in place long back, and then they were modified in order to fulfill certain other requirements which have come into existence globally. So, and specific onus has been put on many type of businesses like real estate agents or brokers, then also the gold and jewelry business, the auditors, the consultants, which are primarily could be involved in handling of client funds. So anti-money laundering regulations have tightened. Of course, apart from that, the US FATCA and the common reporting standards also are in existence, and which many of you would have also seen, and from your dealings with the bank understood that you need to have a declaration of the tax residency of the owners, the shareholders, and the beneficial owners of the company. And this is again from the tax transparency perspective, because this information is used for sharing of the information with the other tax authorities. So if a person, for example, is an Indian tax resident, sets up a company here, and his status is declared with the bank as Indian tax resident, the information about his company bank account, his personal bank account, and the balances and the transactions in that could be shared automatically with the UAE Indian tax authorities. So this common reporting standards has been in existence also, which is again a multilateral, and information is shared between many countries by UAE and correspondingly by overseas countries with UAE. Bankruptcy law also has been announced. It is implemented already, and it is also taking shape as many companies have also now other avenue for filing bankruptcy. Apart from bankruptcy law and regulation, there is also changes in the decriminalization of check effective from this financial year. So there have been many such changes which have happened. There are anti-bribery provisions also in the UAE regulations and law. Country by country reporting, which is of course applicable for large multinationals. And going forward from 2023 June, corporate tax is also proposed to be introduced, though the regulations have not yet been announced. We are expecting those to be announced. Along with that, we also expect that the transfer pricing guidelines for transactions with group companies or related parties also will come into existence, either as a part of the corporate tax law or as separate set of guidelines. So what would happen is this would complete more or less the entire gamut of corporate regulations for ensuring fair business practices and its governance. So though the regulations in UAE, as we all know, are not very detailed or not so complicated, keeping in line with UAE's motto of minimum governance and keeping it very, very simple. However, as business owners or as management, everyone needs to ensure that the businesses follow these laid down regulations, because non-compliances could carry stiff penalties, and it can also result into discontinuation of the license and apart from the financial penalties. So it is very essential that every company should create its own compliance checklist and calendar of filings so as to ensure that they do not miss out on and they remain fully compliant with all the applicable regulations. So this is in nutshell the brief about the corporate regulations which are applicable and which are very, very important and essential. And going forward, this should not be taken very, very lightly at all, because stiff penalties are applicable, and any non-compliance could result into cascading effect, because things are all linked. One non-compliance could result into blocking of maybe licenses or maybe renewals or registrations or visas, or you really do not know. So it's very essential that ensure you have compliance calendar to ensure that you are on timely basis complying with all the relevant corporate regulations. We, of course, at GBS can assist you with ensuring that you are fully compliant, and which will come to in the later part of the session. With this, I'll conclude on my part, and I would request Kinjal to take up on the changes and the updates on the UAE VAT law and the regulations. Thank you.
Thank you, Mr. Vipul, to give us such an insightful overview of the tax regime in the UAE and how corporate compliance is playing a vital role for doing business in the UAE. Good afternoon, everyone. I hope you all are doing well and keeping safe. As introduced, my name is Kinjal Mehta. I work as a manager tax and compliance with Global Business Services, DMCC. The year 2022 has got about many changes in the tax regime. We would like to explain you here the updates on the designated zone related provisions, the public clarifications on the mobile phones, the extension of due date for penalty amnesty scheme, the new scheme introduced for installment waiver and refund of the administrative penalties, the updated guide on the voluntary disclosure scheme, and the need of exit certificate to prove export of goods. And lastly, we will conclude with the FTA audit procedure and what things you need to keep in mind when you face a tax audit. Let's go to the first amendment. The VAT treatment on supplies made from the designated zone is governed by Article 51 of the UAE VAT Executive Regulation. The UAE Cabinet has amended the said provision with effect from 30th October 2021, and they have issued a public clarification in this regard. The FTA has clearly mentioned that the onus is on the DZ supplier to ensure that it treats a supply correctly for the VAT purposes. So, as a general rule, the suppliers should not treat the supplies as out of scope unless an exception applies to it. The first amendment in Article 51 deals with the supply of goods made within the designated zone. So basically, they have extended the scope of supplies made within the designated zone. The second amendment is in relation to export of goods from the DZ to outside UAE. To treat this as out of scope, certain conditions need to be fulfilled. The DZ supplier has to ensure that it retains the commercial or the official documents in relation to such a supply, as well as custom documents evidencing that the goods have moved from the DZ to outside UAE. The commercial documents could include the airway bill, the bill of lading. The official document could include like an exit certificate or an import or export declaration. In case these documents are not presented before the authorities, they may challenge the out-of-scope VAT treatment. The next amendment is in relation to movement of goods from the DZ to the UAE mainland. So prior to this amendment, there was no clarity on the VAT treatment where goods are moved from DZ to mainland. VAT on goods, on supply of such goods and the subsequent importation was resulting into double taxation. So to remove this double taxation and to treat these supplies made from DZ to mainland as out of scope in the hands of the DZ supplier, the amended law requires the DZ supplier to obtain and retain official documents evidencing the import into the UAE, and also retain evidence with regards to the VAT that has been paid to the department by the customer. So diesel supplier would basically require to obtain evidence that VAT under RCM has been accounted by the customer, and also retain a document which says that the VAT on such import has been paid. The official document in this regard would mean a import declaration from the UAE Customs Authority. A new clause, clause 57, is also inserted in this amendment. The basic focus on this is it intends to cover the non-residents who are not registered for the VAT in the UAE and are providing shipping and delivery services as part of supply of goods through e-commerce platform. So this amendment creates an exception for such non-residents from VAT registration if only they are selling the goods on an electronic sales platform and ships or delivers these goods to customers. So basically, if any services are provided within the designated zone, they are taxable at 5%. But with this exception, the non-residents could be out of the UAE tax registration purview. So the amendment really clearly states that the businesses making supplies from the DZ should remain very cautious in determining the tax treatment of the supplies. The next clarification is on the public clarification on mobile phones, airtime, and data packages. The FTA has released this public clarification, which is effective from 6th of December 2021, and it is on the input tax recovery on mobile phones available to employees for business purposes. So this clarification will have impact on most of the taxpayers, as previously there was uncertainty about whether such input tax would be recovered or not. And such services are easily available to employees for personal as well as office use during or outside the working hours. The FTA in this clarification has taken a position that recovery of input tax on mobile phone expenses is only available when a strict business policy is in place and the taxpayer conducts an effective enforcement of such policy. Further, the FTA states that it is not possible to change the policy retrospectively. So therefore, it is likely that this clarification will have an impact on the input tax previously recovered in relation to mobile phone expenses. And if any invalid claims are there, it needs to be corrected. The conditions laid down in the public clarifications are that the businesses should be VAT registered and the businesses should make taxable supplies, and the contract with the telecommunication provider should be in the name of the company. So if there are circumstances where the employee is availing services directly from the service provider and the company is reimbursing those expenses, that may be challenged. The input tax on that recovery could be challenged by the FTA. The businesses are required to have a strict and robust controls in place to demonstrate that to the FTA that the usage of the mobile phone by the employees is being monitored, and they have to substantiate the actual use. If there is a variance between the actual use and the average prescribed limits, that needs to be monitored, and justification needs to be provided as to why there has been an actual usage. The businesses also need to document the policy wherein the action against the employees are taken if the mobile phones are used for personal purposes. They need to retain a proof of action taken by the company for not complying with the documented policy. The businesses also need to obtain and retain the original tax invoices in order to claim the input tax. So considering all these new clarifications, the businesses should now evaluate whether a strict policy should be introduced, or if the entire input VAT incurred on mobile phones, airtime, or data packages available to employees should be borne as a business cost. Let's go to the next slide, which is on the UAE VAT penalties. Recently, we have seen a lot of changes in the UAE VAT penalties. Firstly, the reduction in the late payment penalties from 1% per day to 4% per month. Then there was no late payment penalty on filing the VD if the taxes were paid within 20 business days of filing the VD application. There was this new amnesty scheme which was introduced, wherein 70% of penalties could be waived, outstanding penalties could be waived, which were levied up to 28th of June 2021. There has also been amendment in the tax procedure law for payment of penalties in installments or penalty waivers and refunds. Let us look at the penalty amnesty scheme and the extension of the due date. So basically, this penalty amnesty scheme was applicable if the following conditions were met. The first condition was that the administrative penalties should be levied before 28th of June 2021. The full penalty is not paid by 28th June, or some portion of the penalty is still outstanding. The tax liability should have been settled by 31st December 2022. So earlier, this due date was 31st December 2021, which is now extended to 31st December 2022. Also, 30% of the administrative penalties imposed before 28th of June 21 should have been settled by 31st December 2022. This extension of due date is beneficial to all those registrants who are not able to meet the stipulated conditions by 31st December 21. Now they have time till 31st December 2022 to fulfill the conditions and make the necessary payments, and then obtain a 70% waiver of the penalties that were imposed prior to June 2021. Okay, moving ahead, as we all know, since the introduction of the VAT, there was enabling provisions under the tax procedures law for taxpayers to seek reduction in the tax penalties from the FTA for justifiable reasons. While the provisions were still in place, there was no procedures or mechanism that was prescribed to make an application. There was no clarity on what could be the justifiable reason for waiver of penalty. So to facilitate the taxpayers to avail the waiver or reduction in the tax penalty, the UAE Cabinet has now issued Cabinet Resolution 105 of 2021, dated 28th of December, prescribing the controls and procedures for payment of penalties and installments, waiver of penalties in full or in part, and refund of penalties that have already been paid. This resolution will be effective from 1st of March 2022. It is imperative for the businesses to evaluate their outstanding penalties and paid penalties and reassess if the resolution could be of any advantage to them. So to apply for the new penalty, the applicant needs to make an application to the FTA. The penalty amount has to be at least 50,000 dirhams. The FTA will review the application in the prescribed form and notify the decision. The taxpayer cannot have more than one request of penalty waiver or reduction for the same penalty. The interesting part over here is for the penalties which are already paid, the committee will determine the waiver and refund for the fines that have been collected over the past 5 years. However, the mechanism to seek the refund is still not prescribed, and we will have to wait and see how this goes ahead. Let's go to the amended voluntary disclosure user guide. The FTA has issued the VD, or the voluntary disclosure user guide for VAT and the excise tax. So this new disclosure guide is for the tax groups, the active tax groups, as well as the deregistered tax groups. So the key changes that have come up are the tax group voluntary disclosures can be submitted only by the representative member of the tax group. So if there's a tax group and there are 10 members, only the representative member can submit the voluntary disclosure application, or it can be submitted by the last representative member in the tax group if the tax group is already deregistered. The other tax members, the other group members of the tax group will have only the right to view the application. They cannot make the application on their own. The VDs can be submitted only against the submitted VAT returns, the VD submitted earlier and acknowledged by the FTA, or against a VAT assessment that is done by the FTA. The guide also prescribes the step-by-step procedures to be followed in all the above cases. This guide also reaffirms that the voluntary disclosure must be accompanied by an official document which will state the background and the facts about the errors for which the correction has been sought for. This letter is required to be submitted along with the VD application by regular taxpayers as well as the deregistered tax group. So that's it for the voluntary disclosure scheme. Let's go to the exit certificate. So as per the UAE VAT laws, exports are zero rated provided there are commercial and official documents to support the export of goods. The official documents could be the export related document issued by the custom authority, and commercial evidence could be the airway bill, bill of lading, consignment note, and the certificate of shipment. FTA has in few cases requested for exit certificate as official evidence during the audit and while we apply for the refund claims. So the UAE VAT regulation actually does not specify that exit certificate is an official document. However, as per the recently issued automotive sector guide, they have specified that exit certificate is an official document. Also, the custom notice 7 of 2017 specifies that exit certificate is to be obtained for the procedures to prove export of goods outside the country. However, the FTA has started asking for the exit certificates when we apply for a refund or when there is a FTA tax audit. If you are not able to provide the exit certificate, the FTA denies the zero rating of the goods and demands 5% VAT on the entire export value. So how do you obtain an exit certificate? So in order to obtain an exit certificate, there is a requirement of getting your goods inspected and involves payment of nominal fee. There are a lot of companies in the region who are not obtaining exit certificate in order to claim the zero rating. It may be because of the time, the efforts, and the costs that are involved. And also, since it's not a mandatory document, till now, they have not been obtaining the exit certificate. The cost of actually obtaining the certificate is far less than the amount of tax at stake. So it could be like the 5% output VAT or input claimed as refund. So to avoid disputes with the FTA, it is recommended that you obtain an exit certificate for all the export related transactions. So for the past period, for companies to substantiate that the export claim is a genuine export, you may obtain documents like a custom declaration, a commercial evidence, or related supporting documents which could substantiate that there has been an actual export of goods. So basically, exit certificate will demonstrate that the goods have actually been exported from the country. While the bill of entry may be retained by the supplier, it alone will not be sufficient to substantiate the export of good condition. So to conclude, for every export, please keep the exit certificate, export bill of entry, and airway bill or bill of lading or consignment note as the case may be. With this, I would like to end my session and like to hand over to Mr. Whipple to take it further.
Thank you, Kinjal, for the detailed explanation and presentation on the changes which have happened recently over past probably few months or a year by way of either clarifications or guide. And these are very, very far-reaching important changes, which every company will need to ensure they have proper policy and document in place in order to ensure that they are not falling foul of the law. And whenever the audit happens, should not happen that for past periods, if they are in non-compliance, they could be chargeable to VAT as well as penalty on the difference amount, which if FTA disallows. And that's where the audit comes into picture. For the audit, primarily, what happens is, as per the VAT regulation, the FTA has right to carry out audit over a period of 5 years. So effectively, from the time that you filed, another 5 years is what FTA has. So technically, it could be 5.5 or 6 years. And at any point in time, even in 2023, they could possibly open 2018 returns which you have filed and ask for information and clarification. And the audit as such, there are multiple audits which could be carried out. I mean, one is, of course, it could happen at the refund stage. Whenever a company files for refund, FTA requests for information, and based on the information and documents presented, the refund would be processed. But having said that, even if refund is done and at that time refund audit or assessment would have been done by FTA, does not mean that a regular audit of your entire filings will not happen. It does not mean that the assessment has completed and it has happened. So one should be ready and prepared for the FTA audit and assessment at any point in time. And that's where the regular audit or the field audit could come into picture. Because this is when, in regular audit, the FTA will send out the notice. Of course, they would request for the information. And generally, within 5 business days, the information will need to be provided. So it's a very short time frame and window which will be provided for the businesses to submit the information and documents. And that's where it's essential that the businesses will have to be pre-ready and pre-prepared with all the information and document, assuming that the audit could come in at any point in time. Of course, many clients have still not been assessed or audited because I think the focus of FTA has been large corporates and for the refund part. But at some point or the other, the mid and the small sized entities also can expect the audit to happen and the notices to be received. And that's why it's essential that please be prepared with the information and documents, policies, procedures. As Kinjal said, let's say if you're claiming input VAT on mobile phone, you should have the documented policy. So these things will have to be ready. Within that 5 business days that you are provided, it won't be possible to compile unless everything is more or less ready. So once it is submitted, FTA would also review it and then come back if they require further information or clarification. And if they feel that no, things are probably not satisfactory, they could conduct a site visit. And then based on the site visit, they would arrive at a decision, and based on the audit conducted, they could say that, okay, certain income which probably are reported as 0 rated, as Kinjal said, export documents are not in order. And if they insist exit certificates to be provided, or if official documents or commercial documents are not proper, 0 rating may not be permitted, and it might be considered or deemed as standard rated and get added into your VAT. So VAT and the penalty on that. So going back, it could go back for 5 years. Or if some expenses, input VAT on expenses has been claimed and that is disallowed, again, that will add up to your VAT payable. So these are the things which will have an impact, and that's why it's very essential. Businesses will have to be ready. What information FTA could ask for? Categories of income, meaning nature of income that you already are having, because that would help them to assess what could be chargeable. I mean, what could be 0 rated, standard rated, out of scope, chargeable, not chargeable. What is the business and the process that you as a business follow. Detailed transaction listing in the format that FTA requires. Audit questionnaire, again, it could contain quite a few questions. Documents, also some sample of documents. Again, they could pick and choose, saying that, okay, provide us these documents. Trial balance audited financial statements, as well as detailed reconciliation. See, this is very important. Again, as far as VAT law or regulation is concerned, it does not state that you are required to submit audited financial statements. But not having to submit audited financial statement does not mean you are not required to prepare. You will have to prepare and keep it ready, because at the time of assessment, normally they would ask for the audited financial statements and reconciliations, because your accounting record income and your tax or VAT submitted income could differ, and that's where reconciliations would be required. Apart from this, FAF file also may be requested for. So there is quite a bit of information that they would require, and that's where it's essential that please get ready, prepare yourself, and be ready that any point of time, if FTA audit comes, you are ready to provide the information and documents, and you can successfully sail through the audit, so that you do not end up in having the either income being added and taxable, and then on that you have to pay VAT as well as the penalty, because that could compound your financial liabilities. And that's where we can come into picture, help you in early detection of errors and correct it, so that at least the errors, if they are being carried out or errors are happening, it gets rectified at this stage, and going forward it does not multiply. We can also assess the systems and abilities, your system's ability to generate VAT compliant reports. So your software that you are using, are they compliant with FTA and the information what FTA could request for? And this would reduce the risk of penalties. And of course, if there are some errors or omissions which are noticed during the course of our review, then we could also suggest some remedial action and try to see that how the non-compliance can be minimized, and how we can ensure that the financial liability and non-compliance is not there, and we rectify it at the earliest. So this is in nutshell about the major changes and the updates which have happened in the VAT law and the regulations. And of course, on the broader scenario, as I mentioned earlier, that what primarily UAE corporates will have to be ready with is compliance, not just with VAT law and regulations, but also with many other law and regulations which are already implemented, and which requires at some or the other stage certain filings or maintenance of records. Just one thing that I would like to highlight, even UBO declaration, which was there earlier, and which seemed, of course, quite simple and one time, but it's not just one time. If there is any change in the beneficial owners, you need to ensure that the modifications in the beneficial owner gets reported at the earliest. And also you update your records in terms of the register of shareholders, directors, beneficial owners, and maintain that at the registered office address, because again, at any point in time, the authority, the regulatory authority for UBO declaration also could conduct a site visit and demand that are these documents available. So these compliances are very, very important. Having said that, I think we are through with the presentation. Thank you very much, everyone, for joining in today. And I would request now to open up the floor for question answers, and we can have the questions. There is a chat box. You can put your questions in chat, or you can put it in the Q&A, and we'll be glad to answer your questions. And also, if you have any questions, you can raise hand so we can unmute you and you can ask the question. Thank you. Over to you, Prasad.
Thank you very much, speakers, for the enlightening session. Before we close, we would like to take up a few questions raised by our viewers in the chat box. I call upon Mr. Prasad Bonde, Senior Manager, Audit and Taxation.
Yes, thank you, Akriti. Thank you, Vipul sir. Thank you, Kinjal, for this insightful session. Hopefully all our listeners, attendees will be benefited from your views. So now we'll start taking up certain questions. I have a few questions in the chat box we'll be asking. So one question is that why UAE export declaration is not an official document if we compare to exit certificate. So exit certificate and the UAE export declaration both should be considered as an official document. So if usually ED is there in all cases, so is still exit certificate is required?
Yes, as per our experience, FTA has always been asking for the exit certificate because that is the only document that will prove that the goods have actually moved from UAE to outside UAE. So yes, in our experience, yes, it is required. It's nowhere mentioned in the law that exit certificate is an official document. But as I mentioned in the recent automotive guide, they have mentioned that exit certificate is the only official document that will prove export of goods.
Let me clarify one more thing here. Probably the reason why export certificate might be insisted rather than a customs declaration, because what happens is exit certificate at the time you apply, there is an inspection of the goods and the products which are being exported. Whereas in case of customs declaration, the inspection would not be there. It is declaration by the client, and then that gets certified or stamped by the authority. So in that case, if probably if FTA feels that there is some things, incorrect declarations or something, they might insist. And this is what has been the experience with some of the clients who have been requested for exit this document, exit certificate.
Yes, thank you, sir. Next question we have, when a free zone company acting as an agent for the sale of goods to a client out of UAE received from UAE agent of the manufacturer commission, is it liable to VAT? So basically they are getting commission from a deal out of UAE, a free zone company.
Okay. Acting as an agent for the goods, sale of goods. Okay, so in this case, it is providing services, right?
Yes.
Yeah, so then services provided from a free zone company would either be taxable or zero rated. If the client is based outside UAE, then it could be zero rated if the conditions are fulfilled.
Correct. Then one more question is there. When the goods were shipped directly from the manufacturer out from the UAE to the client, also out of UAE. So I think it is a continuation of the above question. So basically, in case of commission income, it will be either zero rated or 5% taxable. It will not be an out of scope transaction, but provided certain conditions are fulfilled, it can be treated as a zero rate supply. Correct?
Correct.
Yeah.
Yeah, specifically, I think when the goods are moving from outside UAE to outside UAE. So
Yeah.
technically, it becomes as an out of scope because it does not touch UAE ports at all.
Yes. But sir, we are here, they are asking about the commission on that transaction. So commission will not be an out of scope. It will be a zero rated supply in that case.
Yeah, see, again, I think conditions will have to be fulfilled in
Correct.
terms of, because see, when it's a service. Now, when service is rendered, there are very many conditions that, because it's an intangible. So just having the shipping happening overseas will not be the criteria. There are other also who is receiving the service. Now, see, the recipient of the service is based in UAE, the manufacturer.
Yes.
It is not, if the customer which was based overseas, for example, was the recipient of service, meaning he was paying for the commission, then probably there might have been possibility. But here, the recipient of service is based in UAE. So, those conditions will be difficult to probably meet in terms of the service revenue specifically. And this is my view. Kinjal, any other view?
Yeah, even I think the same.
Yeah.
Okay, and one more question. If a company has a plan for calling an internet and a company has a policy that employee would be liable to pay anything above the limit of a plan, Will that be considered good and allowed?
So basically, the usage of excess, over and above what is set as per the company policy. If the employee is using more than that, then it would be considered as a non-business use, unless you recover that amount from the employee as an output tax along with the output tax, or you have justifiable reasons for the excess usage. So yeah, if you have a policy in place and you have a monitoring process as to, if there's an excess use, what would be the implications, the employees are aware about it, then you can claim the input tax on that. Else you will have to bear that cost.
Correct.
So
But in
most
this, I
important,
think,
most important in this is to ensure one, policy in place, second, monitoring the usage. So you should be able to justify that the usage also has been for corporate company purposes and not personal.
correct. Another question is that what is the accounting software which would be treated as FTA compliant? So I think the FTA has already approved a list of accounting softwares which are available on the FTA websites.
Yes.
Yeah.
Those are the ones, plus there might be some which may not be approved, but as long as they provide the information what FTA requires, like FAF file or, those, they would be deemed as compliant because the information should be available in the form and format that FTA requires.
Correct. One more question is exit certificate is bill of entry. So exit certificate is not bill of entry. Exit certificate is a separate document issued on inspection of the goods by the customs. Okay, Kinjan, one more question we have. When a supply is made within the same designated zone, the supply will be treated as out of scope for VAT?
So if the supplier is making supplies within the designated zone, it will be treated as outside the UAE if the goods are not used for consumption, or if the goods are incorporated in the production of another goods which are not used for the consumption. So if you satisfy this condition, it would be out of scope. But if you do not satisfy this condition, it would be treated as 5%. Now the question would arise that how would you know as a supplier that how the goods will be used? In that case, we advise our clients to have a declaration stating the usage of the goods by the customer. And in that declaration, you could also have an indemnity, which could state that, if any incorrect information is provided, then they are liable for the VAT.
Correct. In this, I will ask one question. In our slide, we had that amendment section, Article 51, for out of scope transaction. So in that, obviously, FTA will substantiate that transaction with necessary documentation.
Correct.
So does that mean that even for out of scope transaction, we will require exit certificate?
Yes, because in that they have clearly mentioned when it is export of goods from DZ to outside UAE, you either need to have official or commercial documents and custom documents.
Correct. One more question. What is the consequence of employee using the mobile phone in excess of prescribed limit? Will the input tax on such expenses be allowed?
So as I mentioned, the excess use over and above the set limits will be considered as non-business use, unless you have proof to substantiate the actual usage was for business purposes, or if you are recovering that amount from the employee along with the output tax. In such cases, it would be allowed.
Correct. Also, one more question is there. Majority of the clients would not have obtained exit certificates for their zero rate supplies since beginning, since 2018. Can exit certificates be sought for all those old years? I mean, they can be we can get backdated exit certificate, or how does that work?
So ideally, you cannot get a backdated exit certificate because the goods need to be inspected before the exit certificate is issued. So backdated exit certificates are not possible. What probably the companies could now do is try to convince FTA with another set of documents, which could be like your official documents, your import declaration. You could also submit a declaration which is submitted to the other destination country, the import declaration. So based on that, maybe you could try to convince that okay, the export of goods have actually happened. And alternatively, there's always an option to apply for an administrative exception. So that also could be explored.
Will e-invoicing be implemented in the UAE?
So e-invoicing currently is part of the tax agenda, but in UAE it's still not implemented. It's implemented in Egypt and KSA, I guess. But of course, considering UAE as a tech-friendly country, we assume that it would sooner or later be implemented in UAE as well.
Correct. And one question we have: if exit certificate is issued from the supplier, but export declaration is done by customs transporter, is it acceptable for zero-rated supplies?
So I didn't get the question. Can you just?
Because it says if exit certificate is issued from supplier.
Okay.
Maybe I think it is saying that issued in the sense they got it from the supplier.
Okay.
But export
that can happen only if supplier is exporting the goods, no?
Yeah.
Now, if supplier is exporting the goods, then will it not be as delivery locally to the supplier? So supplier pays it. Transfer the goods to the customer within UAE, and then customer himself arranges for the shipment outside and exports it. Because I'm not sure exit certificate issued from supplier, because supplier, anyway, it will be supplier only who will do the exit and export it. So supplier only will have. Customer, I'm not sure how customer will have the exit certificate, unless customer is taking delivery within UAE and then exporting it.
Correct.
In that case, it won't be zero rated because
then it would be local then. Sales.
Next question: is there any chances, as per recent amendment, when goods moving from free zone company to another company within free zone or to a company out of free zone, if it gets consumed in free zone or maintained mainland instead of being used as a part of goods?
No, so if the goods are supplied within the designated zones and they are used for consumption, then they are taxable.
Yeah.
Okay.
So there is no, this was clear from the beginning. There is no new provision for this. This was clear from the beginning.
They have just widened the scope of consumption. So they have mentioned that if the goods are attached or incorporated in another good, which is going to be resulting into another good, which is going to be supplied, then that resulting good also should not be used for the consumption. In that case, you could treat it as out of scope.
Correct. And one more question: do we have to update UBO in case of any change in ownership of the company not conducting relevant activity? So
it is not linked to the relevant activity at all. UBO is different and economic substance regulation is different. So both are separate regulations and needs to be complied with separately.
If there's a change in the UBO, you need to update your registers and you have to inform the authorities that there has been a change in the UBO. And of course, when you file your ESR reports and notification, the same changes have to be affected there as well.
Correct. I think that the previous question, the supplier is obviously the client.
Yeah, so I think what he is trying to say is that the supplier, which is the company which is selling the goods, is exporting, but in effect, the tax invoice is issued by the customer. So technically, then customer is buying the goods locally and then he is exporting it out. So again, see, problem with all these type of transactions prior to VAT and all these regulations was okay, it could continue. Now your transaction flow and document flow has to be in the same sequence. It cannot be in a different sequence. So if you are selling the goods, then you need to sell locally, charge them VAT, then that customer will have to then export it and claim zero rating, and he can claim input VAT. So you instead of, you see, those shortcuts and which were happening earlier, I think, cannot now continue. We'll have to ensure that such things follow the process and system, and the documentation also has to be in accordance with that. Because for zero rating, the authority very clearly mentions that all the information in all this commercial evidence, official evidence has to match, meaning your customer name, your value, your quantity, item, everything has to match in all these documents. If there is a mismatch, there is a possibility FTA could disallow you zero rating and ask you to pay VAT on that sales.
Correct. So I think we have we don't have any more questions, and also we are now short of time. So I think I'll hand over to Akriti for the vote of thanks. Okay, one more question we have got. We'll take one more question. When we make sales invoice to customer in Egypt, and the goods will be sent by China factory, then do we need an exit certificate?
This will be out of scope, because you are buying from China, goods are going directly to Egypt. UAE company, as I understand, is only issuing the invoice to Egypt company. But physically, goods movement is happening from China directly to Egypt. So technically, since it's not touching UAE and delivery or transfer of goods does not happen within UAE, no VAT would be chargeable. It would be as out of scope.
Exit certificate will be required when physical goods are moving out of UAE. Physically goods are moving out of UAE, then the question of exit certificate will arise.
Yes. Okay.
That brings us to the end of yet another interesting session. It was a pleasure having you all here with us, and I'm sure we have gained a better understanding of the UAE VAT law. If you have any further queries, please reach out to us at any time, and we shall be more than happy to assist you. I would like to thank our speakers for taking the time and effort for organizing such an informative session. I would also like to thank our patient audience for their valuable time and participation. Thank you.
Thank you, everyone.
Thank you. Thank you, everyone.
Thank you.